morning, everybody. Good morning. Today is March 25th, 2014. We are at 335 Adams Street in the conference room, and this is the NYCERS investment meeting. It's about 9:45 a.m. You have before you an agenda on pages 1 and 2. Are there any changes, questions, reordering of the agenda today? No? Do we have a motion to adopt today's agenda?
So moved.
Okay, do we have a second? Oh, sorry. My mistake. I'm sorry. Madam Executive Director should have called the roll. My mistake.
Wow.
Okay, Chair,
Here.
Controller's Office,
Here.
Public Advocate's Office,
Here.
Borough President Manhattan,
Here.
Borough President Brooklyn,
Here.
Borough President Queens,
Here.
Borough President Staten Island,
Here.
Borough President Bronx,
Here.
International Brotherhood of Teamsters,
Here.
Transport Workers Union,
Here.
District Council 37.
Here.
Have a quorum.
All right, thank you. And so we had a motion and a second to adopt the agenda. All in favor? Any opposed? Okay, motion is passed. And so I will hand it over to Seema for the performance reviews.
Thank you. So everybody should have the color monthly performance review in front of them. Okay, so this is January numbers, and we went through those, you might remember, in the last few board meetings. Lots of uncertainty in January. The markets were down, U.S. stock markets, non-U.S. stock markets. Uncertainty around China, you might remember, what the Fed may or may not do. Are they going to continue to taper these bond purchases? New Fed chair, Janet Yellen, what is she going to do? That sort of flipped on its head and went the other direction in February, so we had a big up February, and we'll go through those numbers. And now where we're sitting, as you might remember, I mentioned this is going to be a rocky road for a while. March has been bouncing around a bunch because the uncertainties really do remain. They just seem to figure themselves out month to month and go back to where they were again. And so here we are today, and the Fed chair last week had her very first press conference, and lots of differing interpretations about what she said and what she didn't say. But basically, they backed off of their sense of when we hit 6.5% unemployment, we're going to start to increase interest rates. So they backed off of that. It's now a matter of when are they going to raise interest rates. She sort of tried to give guidance around that. I think it's going to stay low. Rates are going to stay low for a long time. I think that's the underlying message, and she did continue to taper bond purchases. So now we've gone from $85 billion a month to $75 billion a month to $65 billion a month, and now we're down to $55 billion a month. So the Fed seems like the economy is doing okay, and they'll continue to taper these bond purchases, and then it's still open-ended about when rates will rise. But that's why you're seeing a lot of this bumping around in the markets. So why don't we turn to page 27 and look at the January numbers. Again, you've seen these before. So if you look at the 1 month, the Russell 3000 was down about 3%. The EFA markets were down about 4%. The emerging markets were down about 6.5%. You scroll down some more to the Core Plus 5 on the fixed income side, up about 1.7%. High yield up about 75 basis points, and tips up nearly 2%. Same with convertibles, up nearly 2%. Now you flip the page, and you see the much better month in February. And you can see the Russell 3000 up 4.74%. The EFA markets up 5.5%. Emerging markets up over 3%. You go down to Core Plus 5, up 75 basis points roughly. High yield up 2%. Tips up 45 basis points, and convertibles up over 4%. So a very strong month of February. Now page 29 shows the breakout of where the money came from in terms of which asset class added value. And you can see here it was a down month. right? This is January. So the total fund down about 1.5% for the month. Fiscal year to date, the total fund return is 8.44%. Now, if you add in February, which was a very strong month, which we estimate we were up about 3%, that would mean that NYCERS, the total fund for the fiscal year to date through February, is up over 11%, which is a very strong number. So that's a good thing. If you turn to the page next, 30, this is the asset allocation and how we're set up. Again, this is as of January 31. So you can see here things that we had talked about before in terms of rebalancing, you're now seeing here in this picture. So the left bar, the green, that's U.S. equities, is now within the range. And you see the bluish bar to the right, which is Core Plus 5, is also within the range. So rebalancing we've continued to do, and we're within the ranges now, and so we're in good position, we think. Now the last thing I'll say before I'll open it up if anyone has any questions is, so the total fund you see here on page 30 is showing $49.8 billion. That's as of January 31. I can tell you now that as of March 21st, which was Friday. The fund is now at $51.3 billion. So again, it's a new high for NYCERS, and it's a great number. The rest of the book you can see we now have the manager performance numbers by asset class, and we have the cash flows for real estate and private equity. And if there aren't any questions on any of that, then we'll move to the next item. Good. All right. Thank you. So, we want to do the courts? No. All right. Okay. So next we'll move on to the risk presentation, and John is there. And everyone should already have a handout on risk. John, you want to sit here?
What? I'm going to put my liabilities on in big bucks. Seems appropriate somehow. Also, my voice doesn't carry as well as yours.
All right.
Yeah. This will be the third time I've talked to you all about your risks, and I'm going to do something different this time than I've done in the past. What I'd like to do is talk not just about the risks of the assets, but everything. So liabilities, off-balance sheet guarantees, assets, pull everything onto the balance sheet and market to market. Now, why would I market to market? It's a consistent yardstick to determine where our risks really lie. For instance, if we look only at our assets, we would say our predominant risk is equity risk. If we look at our liabilities, our predominant risk is interest rate risk. Which is bigger? Well, we need a common yardstick to determine that. And the yardstick I'll use is mark to market. Let me remind you of what mark to market is. It's for an asset, what an unrelated third party would pay us for an asset. For a liability, it's what an unrelated third party would charge us to assume one of our liabilities. It also recognizes value not when amounts are paid, as we typically do in cash accounting, but when the obligation is entered into. You bring everything forward to the present time and value it, even if the payment is 10 years from now. If you're obliged to make a payment 10 years from now, you record its value today. The other thing I'm going to do is, it's my belief that although we have 5 separate funds, the risks of the funds are commingled in such a way that the only way to really look at the risk is to look at it on a consolidated basis for all 5 funds. So what I'm going to show you is what the mark-to-market balance sheet looks like for all 5 funds taken together. Finally, I should apologize. I think this is the best way to look at the risk, and I apologize. It's taken me 3 years to get to this point and have had false starts along the way in showing the risk in other ways. In my defense, it's actually very hard to extract enough information about our liabilities from the published reports, the CAFRs and other reports, and it's taken me quite a little while to put it together. My hope is that now that I've established a framework and gleaned most of the necessary information we'll need, I can hand it off to my successor, and this can be the template for risk presentations going forward. As we go through, where I depart from the CAFRs, or where I feel that I still don't have a sufficient understanding of some of the liabilities, I'll try to make that clear. All right, if we,
Thank you.
and we're looking at the risk management presentation, which is a little small packet. All right. First thing to look at the balance sheet is what our income will be in the coming year. And the first number may strike you as odd. We will earn, on a mark-to-market basis, $11 billion in the coming year. This may seem strange when SEMA has gone through a whole presentation of how good our return has been, and we look every month at our returns. But in a real sense, we know exactly what we're going to earn in the coming year. We're going to earn 7%. Because if we earn more than that, we have a payable to the city. That payable gets made over time, gets put into actuarial formulas and averaged and then paid over 20 some odd years. But on a mark-to-market basis, if we earn more than 7%, the fund will be debited in the long run and to repay the city. If we make less than 7%, the city owes us money. So we will earn 7%, period. So that's $11 billion. We will also receive from the city, across all 5 funds, $9.5 billion in annually required contributions. And here I'm departing from the CAFR. I think the CAFR for the city says 8.25, but NYCERS is a multi-employer plan, and the other employers, who near as I can tell are creatures of the city, put in the other 1.25. So in the end, the city is on the hook for $9.5 billion in annual required contributions this year, and they go up 3% every year according to the actuary's formula. And we have about $800 million of employee contributions coming in. Again, the CAFR, if you look at it, says $1.7 billion of employee contributions to fiduciary funds, but that includes 457 plans, IRAs, et cetera. So the employee contributions to the pensions are about $800 million. So that gives us a total of $21.3 billion of income. Now, before I leave this page, it's worth looking at that guarantee of 7% and saying, what would the market guarantee? Because you can get guarantees in the market. You can go to a financial institution, pay them the return on our portfolio, and receive a fixed return in exchange. You can go out about 30 years in that market. And the fixed rate you would get is 3.5%, not 7%. So of that $11 billion, about $5.5 billion is coming from the city's guarantee of our income. Which means of our $21.3 billion, $15 billion of it is attributable to the city of New York. This is why I say we have to look at the risk on a consolidated basis. All the funds face the same obligor, the city of New York. If the city's finances are healthy, the funds will get enough money to pay the pensions. If the city is impaired in any way, there will not be enough money. No matter how artfully and well we invest the corpus, it is not paying the pensions. The city of New York is. what do we pay out every year? Roughly $10 billion in pension benefits, which the actuary projects to grow at 3% every year, in line with growth of the government, wage increases, and inflation. We also pay out about, this year, $1.6 billion of non-pension benefits. And by this, I don't mean health care. I mean non-pension benefits paid out of the earnings of the corpus of the pension plan. These are VSFs, the variable supplemental funds for uniformed services. That's about $400 million of it. About $1.2 billion of it is in the teacher system and the Board of Ed, where the members have what's called a 403B plan, which is like a 401k, but it's for educators. And one of their choices is to lend money to their own pension plan at rates of 7% for teachers and 8.25% for Board of Ed. There's about $17 or $18 billion being lent by members to those plans, so that the teacher's plan has a leverage of, for every $3 in there, $1 of it was borrowed from the members, and for Board of Ed, it's leverage of, out of every $4, $1 is borrowed. These are important because they're growing very rapidly. First of all, earning 7% or 8.25% is a very attractive rate, and it attracts money. The other thing is they're compounding at rates of 8.25% and 7%. So these liabilities are growing faster than anything else, faster than the corpus, faster than the pension liabilities. And then finally, about $400 million of investment management fees. We tend to focus our attention very heavily on fees and what can we do to reduce fees. That's a wonderful thing to do, but it's a drop in the bucket. It's a very minor part of our balance sheet. What does the world look like when we mark these cash flows to market? So the next page is the market value of our liabilities. First of all, the pension benefits. If I went to a long-term annuity provider, I would be lucky to get an annuitization rate of 5%. Might even only be 4%. So we have a stream of payments of $10 billion a year going out into perpetuity, growing 3% every year. And I will be optimistic and say we could annuitize it at 5%. So discount that at 5%. That comes to $500 billion. That's the market value of our pension. That's what we'd have to pay a Fidelity. If we're lucky, we could get $500 billion. Or we would only have to pay $500 billion to them to assume these benefits. The non-pension benefits, because they're growing so rapidly at 8.25% and 7%, come to $120 billion. And the investment management fees, the stream of investment management fees, about $20 billion. You know, if we brought trading in-house, we might be able to cut that to $10 billion. But as I said, it's a drop in the bucket. Now, what drives the present value of the pension benefits? Two things. One is the interest rate at which we discount them. And to give you a feel for the sensitivity to rates, if annuitization rates were 4% rather than 5%, that number would not be $500 billion, it would be $1 trillion. If rates go up and we can discount at 6% instead of 5%, the present value drops to $333 billion. We have an enormous sensitivity to interest rates in our liabilities. The best thing that could happen to this fund is for interest rates to go up dramatically. Yes, we'd take a bloodbath on the asset side. We have fixed income assets that would get crushed. Presumably, if rates went up dramatically, equity markets would lag. We might lose tens of billions of dollars on the asset side, but we would make hundreds of billions of dollars on the liability side. The other thing that affects the value of the benefits and the present value is the assumed growth rate, which Bob's not here, but he would tell you that's largely driven by projections of wages. If wages grow at a slower rate than Bob projected, it has the same effect as increasing interest rates. If, for example, wages grow at 1% rather than 3% every year on average, then this number would drop to 250 billion from 500. If wages grow more rapidly, if wages were to grow, say at 4% rather than 3%, it goes back up to $1 trillion. So it's very sensitive to that. So then what do we have for assets? Across the 5 systems, we own about 150 billion of securities. The employee contributions present valued to about 40 billion, which leaves a gap of 450 billion. That is essentially what the City of New York has pledged to fill. That gap, so we're facing the City of New York on a gap of, through the guarantee of the 7% and the ARC payments of roughly $450 billion. That's a staggeringly large number. To put it in perspective, New York City has roughly 45 billion of general obligation bonds outstanding. So its obligation to the pension funds on a mark-to-market basis is 10 times larger than the amount of bonds outstanding. So, if interest rates go up and go up dramatically, this picture starts to look better. So, when looking at our risks, what we have to do is plan for what happens if interest rates don't go up. What if low interest rates are with us for the foreseeable future? What happens then? The mark-to-market is telling us that we have too big of a gap to plug. If interest rates go up and the city essentially owes us $450 billion, it will never be paid. It's too big. And here's what I think will happen. At some point, maybe 5-10 years down the road, equity markets will enter a very bad patch, because that's the nature of equity markets. There are very good years, as we've experienced for the past few, and then there are very bad years. When we hit this run of bad years, the required payments from the city to the pension plan on a cash basis, not a market basis, but actual cash outflow will go up and up to the point where it's simply unendurable and the city cannot pay. And then what happens typically is we decide we don't make payments to replenish the fund over a generation, but over 2 generations or 3. Or we'll cut benefits for the coming generation. Or eventually you may end up in a defined contribution plan rather than a defined benefit plan for future employees. But that is the path we're on if we continue with our current asset allocation and the current way we've been behaving. It's all but inevitable, unless interest rates should go up a lot. That would be what saves us. Now, how have we come to be in this fix? You know, the cornerstone of a defined benefit plan is fairness across generations. It's very hard to do. You have to project earnings. If you put too much money aside for future generations, then you don't pay the current generation enough. Or if you pay the current generation too much, you don't have enough for future generations. And that sort of intergenerational equity you will hear actuaries talk about, I call it fairness, is hard to do because you have to make assumptions about the future, and it's particularly hard for us with our governance. But I think that we have for a number of years, systematically erred on the side of favoring the current generation at the expense of future generations. How have we done that? By assuming a very high earnings rate for the funds, which allows us to spend more money now because we assume we'll earn enough to make it up later. By, as we did in 1999-2000, when we have a run of good years and we have substantial gains, we have harvested them and spent them, again taking away from money that could have been there to provide for the future generations. And very importantly, we have used the pension plans to subsidize non-pension benefits, thereby taking money that could have been put aside for the future generations and spending it on things we want now. The way to redress this imbalance is to err in the opposite direction, to err on the side of being conservative and making sure that we have defined benefit plans for the future. And I cannot stress too highly that now is the time for the boards to be thinking about these things. If you wait until the cash flows are telling you that we have a problem, it's much too late. The mark-to-market is not always correct, but it gives at least an advance warning of what is coming. So what can we do to ensure that we provide for the future generations? Ideally, we would drop the earnings assumption to 5%. We can't. The city doesn't have anywhere near enough money to put in. But the boards and the city can behave as if we did. If we have a run of good years, don't harvest it. Put it all aside as if we were discounting at 5% to make sure that we build the corpus as rapidly as we can. Because we really need to get it up to a point where we're not dependent. Yes, I'm sorry.
You say put it aside. What do you mean by that?
If we have a bunch of years, 13% in a row, and the actuarial formula says, oh, we can reduce the city's payments, don't reduce them. Continue making the annually required payments. Don't think, oh, now we can free up money in the budget for other things. But put them aside as if the city's required payments were 15 billion or 20 billion. We can't actually make them 15 or 20, but if we have a run of good years, we can put that money aside. We really have to think long and hard about whether we can continue to subsidize non-pension benefits with the pension funds. And that's an extra burden of at least 100 billion, and perhaps as much as 200 billion. It's very difficult to know where we cap that leverage. And we really have to think hard about our asset allocation if it's optimized for a low interest rate environment going ahead. Should we be trying, while interest rates are so very low, to earn yet still more money so we have enough put aside that we can survive the long spell of low interest rates? Should we be leveraging? Not at 7 or 8.25% as some of the other funds do, but NYCERS could leverage its portfolio at 25 basis points. That's the market rate, in order to try to boost earnings. But these, I think, are the important things that really now is the time to be thinking along these lines. And I must say, I have been to many of NYCERS meetings, and I've been struck by how very much time is spent looking at each individual manager and each individual asset class. And Pat, I've heard you say, it's our money, and we want to meet the managers of our money, but it's really not your money. The corpus does not pay the pensions. The city does. The whole point of the corpus is to reduce the burden on the city. But for at least a generation, and probably beyond, the earnings of these funds will never be enough to pay the pensions. It's all coming from the city. I would encourage you to spend less time looking at individual managers, looking at country lists and the details, the minutiae, because it just doesn't matter. That's not where the big bucks are. You can leave that to BAM. I would encourage all of you as trustees to look at the really big issues. Is there anything we can do to slow the growth of the liabilities? Is there anything we can do to get the non-pension liabilities out of the pension corpus? And is there anything dramatic we can do with the asset allocation that might give us a better chance of making this work? Because again, the mark-to-market tells us this ain't going to work. And we really have to think hard about what we do now. And with that, I'll take questions.
Yeah,
Yeah.
the VSF is going to expire at a certain point, I believe.
I don't know. VSF, yes, when I present value it, the VSFs do not contribute materially. It's all the
Okay,
leverage.
It's part of the non-pension benefits?
Yes.
And the 403B is part of the pension benefits?
Non-pension, yeah.
Non-pension benefits?
The 403B is what contributes to the growth. Because
More
it's
than
growing.
the VSF?
Oh, much, much more,
Yeah.
yes. The VSFs, even if they don't expire, they're level payments. So over time, yeah, they don't grow with wages, they don't grow with budgets, they're just
Yeah.
flat payments. So the present value of those is not nearly as material as the 403Bs.
This is all legislation, I believe.
Yes?
Yeah, you can't change this unilaterally.
No. One reason I'm making this speech to this board is it has many political representatives who
Yeah.
presumably have influence with the legislature.
There'd be a lot of pushback on that, I'll tell you that.
No, but the end result, if we don't push back, is the end of defined benefit. It really is. Because this is just, we're going to hit a bad patch.
I had a question also
Yeah,
about the actuary.
yes.
Any discussion with the actuary on this?
Yeah, Bob's not here. He has seen it. We've talked back and forth.
He's
Yeah,
a-
Bob uses actuarial rates. I'm using the market. They're different.
Is there agreement on this? I'm just curious.
If we use market rates, he has no quarrel with the numbers. Yeah, some of it's quite hard, and reasonable men can disagree. For instance, I have capped the leverage in teachers and BERS at what I think is, as far as we might go. We might go further. We might grow those. They're still growing. And I may have capped them prematurely, so that only makes that number worse. But with the liabilities, the pension liabilities are fairly straightforward. It's a mature plan, so there's not a whole lot of demographic detail. Yeah.
Can we get what does BSF stand for as far as the acronym is concerned?
Oh, it's called a variable supplemental fund, but it's neither variable nor supplemental. It's already been folded into many of the pensions. But initially, it was a fund. In really good years, some of the earnings would be skimmed out of the pension plan and put into a separate fund to pay extra benefits. But that's over with now, pretty much.
And as far as the expiration date on what Pat was mentioning, what is the expiration date and for which one?
The VSFs, I don't think they have expiration dates, but they effectively do because it's a flat payment. So just with inflation and overall growth, that payment becomes worth less and less and less over
So
time.
there's similar to an annualization? Or?
No, it's just $12,000 a year. 200 years from now, getting $12,000 isn't going to amount to much.
So that's not really, when you speak of liability, as far as the non-pension benefits are concerned, that's not where the real...
No, the bulk of it is coming from the leverage in teachers and BERS, yes.
And these are the only two non-pension benefits under $1.6 billion?
That's all that's there, yes. I mean, one could make a case where sometimes we will make investments knowing that the yield will not be great, but because it serves some good purpose, one could argue that also we should take a very hard look at when we need to earn so very much money. But I did not include that there. Yes?
So in fact, very little of the non-pension benefits are attributable to NYCERS.
Yes, because it's essentially only the VSF for corrections officers. Yes. But nonetheless, they are a concern to y'all. I realize you are directly in charge only of this fund, but you're all in the same boat. If those grow to the point that the city cannot pay the money, it affects you just as surely, because you're all obligors of the city. You're all completely dependent on the financial health of the city. So really, it doesn't even make sense to have 5 separate funds. You really have to talk to your trustees and all the other funds because you're all in the same boat.
What is your forecast of interest rates going forward?
Well, risk managers traditionally don't take a view other than to assume the thing we don't want to happen will happen. And what we don't want to happen is interest rates stay low, so that is my forecast. Yeah.
And, excuse me, to your point about asset allocation,
Yes.
you suggested that we all think about the actuarial hurdle rate to be 5, even though it's at 7.
Yes.
So that would assume that you would have a more conservative.
No. I'm saying for purposes of harvesting gains.
Okay.
On the other hand, if interest rates stay low for a while, look, these funds don't earn more than 25 basis points. We have a heap of trouble. We can leverage at 25 basis points. I would seriously consider leveraging NYCERS up to try to make not 12%, but 16 or 17% in the near future. Put every penny of it away so that we have money to get us through the period when it becomes apparent that interest rates aren't going to go up.
But if you leverage and get more aggressive, there's a chance that you could lose.
Yes, but if the leverage loses, we've already lost because we were making so much. If we're not making 25 basis points a year, which is the cost of leverage, then fairly quickly the ARC payments will go up to a point that the city cannot pay them. And that's the beginning of the end anyway.
In our opinion,
Yeah. And it all comes down to, in my mind, whether we want to preserve defined benefit pensions. I think they're a wonderful invention. The problem with defined contribution is if you happen to live in the generation when markets are bad, you won't have very much money. If you happen to live in the generation when they're good, you'll have more than enough. The beauty of defined benefit plans is it spreads the risk across generations. It's a wonderful invention, but we have to make sure that we're actually being fair to the future generations.
Any more questions for John? Thank you very much.
No, I mean,
Yes?
I would like more information on the non-pension benefits, a breakdown, details, the math behind it.
Yes.
This is one
It's
thing I
actually
love,
very,
but-
very hard to do.
I mean, not now. I'd
Yes.
like that in writing. Like,
Well-
I'd like a much more thorough document so I could read through for myself on all the various non-pension benefits, the numbers behind them. You could send that to us. Distribute that.
Yes.
I'd like to better understand how you got to your 120 billion
Okay.
and
I
the growth
will,
on that over
yes.
time.
I will tell you, nowhere is the amount of leverage published. What I have had to do is infer the amounts of it by looking at interest payments flowing from the teacher's retirement system, QPP, into the TRS. So I can tell you what I have inferred from the CAFRs, but you won't actually find these numbers published anywhere. It's all inferential.
So you can't provide us with a write-up as to...
I can tell you what I have inferred, but I cannot point you to an actual published number because they don't exist in the CAFRs.
Okay.
Thanks. Any more questions or comments for John? We appreciate that.
Thank you, John. So everyone here, for those of you who don't know, so John Wright is our head of risk, and he has very graciously agreed to stay on through these years of helping us think about a lot of these important issues. And so we expect John to bring up all the hard things that we all need to think about. It's up to the boards to then move forward in terms of how we might react or respond to what John's brought up, but it's very important. We're really happy that John has brought all these issues to the table because they're hard issues, and we all need to be thinking about them. So thank you, John.
Thank you. Yeah.
We did, just to clarify them, John has honored us with his own assessment of things, which is not necessarily that of the Controller's Office.
Well, I don't work for the Controller's Office, I'm a volunteer. So, but,
Very good.
yeah. And it is my assessment, but most of what I've given you is not opinion, but observation. It may be flawed observation, but the beauty of mark-to-market is it's experimentally verifiable. If you think I said way off in my estimation of the value of liabilities, you can construct an experiment. You can go to a Fidelity and ask them, what do we have to pay you to assume some subset of our liabilities? It would be very instructive. And I think you'll find that I've actually been optimistic, which is not my nature, but I've been optimistic. You might get.
Despite your last name. John Bright, have a good day. Very good.
But before we move on to the educational session, we had a quarterly report on the agenda. Is that something that you want to talk about today, or is that just for informational purposes?
Yes, thanks for bringing that up. So we have many of these quarterly books, not all that we intended to bring. Somehow a box didn't arrive here. But what we wanted to do is at least present those that we had, and if there are any questions, to please relay those to us at any time. But the next time around, we will have the full set of books. So, thanks, yep.
Would you like to introduce the next item?
Sure. So up next is the emerging market debt education. And Callan's passed around the books, so you should have that in front of you. And before I turn it over to Martin, just to remind the board, this is something that, while there is no allocation specifically formally for this, we wanted to present the education now because we will be doing a search for emerging market debt managers, and it would be a very good thing, and I think Callan will discuss this and concurs, that just be a part of the search, whether or not you need to implement or want to implement anything. As far as allocating money in this area, you at least have the option down the road when, in fact, the board might want to do it. So it's a good, timely thing to think about. It's good to, I think, join along in the search in any case. And so that's why we're bringing it to you today. And I will turn it over to Mark.
So thank you, Seema, and you just took everything I was about to say. But I do want to point out, you don't have to turn to it if you don't want to, but in the book of the colored slides on page 32 is our asset allocation, and you will not see emerging market debt on there. The reason you don't see emerging market debt on there is not because we don't believe emerging market debt can help earn returns and help diversify the portfolio, but because of the legal limitations. Presently, the asset allocation takes NYCERS up very close to 25%, and we have a slide in here that shows you on page 141 of the book where we are in the basket, and we're just a few percent away with still more to implement. So it's not presently in the asset allocation. However, as Seema said, one of the city systems does have some extra room and is using that for emerging market debt. We see this, as Seema said, as a free option for NYCERS board before Callan goes into their education. Since we're doing a search anyway for emerging market debt, we would like the board to allow us to use Callan's services to participate in the search. The reason for that is, in addition to the other system participating, which does not affect NYCERS, but in the event and in the hopeful event that the basket law is revised, emerging market debt will be a likely item that Callan will bring up in a revised asset allocation coming up. So since we're doing the search anyway, and since Callan is likely to recommend, and don't want to put words in their mouth, it'll come when it comes, the new asset allocation, we will have a fresh list for you with managers that Callan has recommended. This is a free option, and what I mean by that is, if you allow us to have Callan participate in this search, You can, if the law's changed, invest and select managers that Callan recommends. But what you could also do is say you're not interested. So you have no obligation to actually select emerging market debt for your asset allocation or do emerging market debt. But in the event that you do, you will then have at that point, probably later this year, fresh options available. Otherwise, we'd have to do a new search just for NYCERS. Since we're doing the search anyway, we thought it would be a good idea for NYCERS. And we're going across to all the boards as well, because they're in the same predicament of being at their 25% limit and they don't have emerging market debt.
Is there an update on the legislation that would increase the ability to invest in these particular investments?
I'll turn it over to Suzanne.
We don't have anything final yet. I know it's a big priority, and we've been trying, and it's just sort of caught up in Albany back and forth. We're working on a bill draft, and we're working on talking to leadership up there and leadership in state pension funds, but we don't have anything concrete to bring to you guys other than we're working on it. Hopefully, we'll have a presentation at the April meetings.
So does that mean we don't think anything will get passed this session?
Not at all.
Okay.
It just means that in typical Albany fashion, we don't know anything until we know it.
And would it help if there's a resolution passed in the city council calling upon the state?
A home rule message?
No.
That's what they want, a home rule?
No.
It's just a
It's just a
resolution
resolution.
with no legal import.
I mean, we could definitely talk about
Right.
when we have a bill draft.
Right.
Yeah.
That could be great.
So the bill hasn't even been drafted as far as language is concerned.
It's
and
pretty.
assigned a
It's
number.
pretty simple. It hasn't been. We have a draft, but it's not an official draft because it hasn't been assigned a number, and it's sort of like in that back and forth kind of. Like some conversations need to be had before it gets to the next step, and once it gets to that step, it's all guns blazing and full steam ahead. But we just are talking to people.
And it's both houses, Assembly and Senate,
Yes.
that you're referring to as far as language is concerned.
Yeah, I mean, it's pretty straightforward language. There have been different incarnations of the bill that have been passed, I think, over the past 10 or 15 years that raised it, I think, first from 15 to 25 and to where we are now. So the language is there. It might just be changing a numeral in the current statute. So it's more just getting it to the point where people need to start advocating for it.
Have we or have you guys lined up both timelines? So how long we have from the investment side where we start bumping into the ceiling and really having a problem, and then the Albany clock, which is its own clock? I'm just wondering if the two are going to meet.
Yeah, I mean, I think, and Seema and Martin can talk more about the investment side. I think, we're getting close, and, when we want to address this and take care of it so it doesn't become a problem. But since the Albany clock is what it is, going down to the end of June, if we can just get it taken care of then, we don't foresee a problem. But it all depends on what happens with the market between now and then, where we are, with the basket of investments. It takes a long time to implement any kind of new decisions that we need to make, so nothing's changing immediately.
Okay.
I mean, we can give you an update on where we are in the basket.
It's actually on page 141. It's a summary.
Your big book.
Yeah, in your big book. And you'll see that we're just a little over 2% from the 25% on an invested basis. So, and we still have more to go.
So what happens if it doesn't get introduced this session? I mean, I'm just asking. I mean, I hope it does. We all do. And that's what we'll work towards, but I don't know. Have we
It'll
thought about the
continue.
Tuesday scenario?
Yeah, I mean, I don't know how long we've been at this number. I don't think this number fluctuates
It's
greatly.
been going up.
As we
right?
invest
Because
in
we-
opportunistic and hedge funds, it increases.
Yeah. And
Which-
that we still haven't fully built out.
Which
right?
we knew
So-
when we adopted in 2011 the asset allocation that would have.
So we need to do this, and otherwise it'll just limit what we can do. as a board in these non-traditional asset classes?
Are there sponsors already?
We're talking about that. I think they want it to come from leadership.
Right. But ideally, this would be, sorry. Ideally, this is going to be a post-budget item. Would that be fair to say?
Right.
And so they will all focus on this post-budget, and then all forces will come to bear to get it passed. So, as someone who's worked in the legislative process, it takes time.
Yes. We're just trying to tee up for that point, exactly.
Not today, and definitely not right now, but at some point, I know my principal very much would like a briefing on the conversations you're having with people and on what the terrain looks like, how big a lift is it going to be to secure the votes needed to get this through, what is the current position of the various leaders of the legislature. We're going to want that at some point.
Certainly by borough, I would say. So if we could be helpful.
Yeah, absolutely.
Soon.
Yeah, when we have it. We can have that conversation offline, a little bit more strategic.
Before I turn it over to Callan, so that's ultimately why we're bringing you the education piece, is for potentially doing this in the future so that we can potentially quickly turn around and do it since it'll be fresh. I also want to reintroduce, a lot of you are new trustees and haven't met Wesley Pulisic. He's on our fixed income team. He'll be part of the key person on the emerging market debt search. He's our Fulbright scholar, and that's true. And he's our go-to guy on lots of things, and he's a key person in getting a lot of the information that you see here done for us, and also understands how to get things done. So for emerging market debt, he will be a key person, so I want to introduce, for those who have not met him, this is Wesley. But I'm going to turn it over to Callan unless there are further questions.
Okay, thank you, Mark. So as Martin and Seema talked about, last time we did the asset allocation in 2010, we actually considered emerging market debt as well as a number of other asset classes. But because of the limitations on the basket clause, we had to decide, which asset classes we wanted to include in the portfolio to, have the best risk-adjusted returns. So in that case, it was more important to add opportunistic fixed income, to add emerging market equity, to add hedge funds. So it just was not the fact that we didn't like emerging market debt, but we got bigger bang for our buck in other asset classes. So as the basket clause hopefully will expand, when we do the new asset allocation, we may, and I don't say we definitely will, but we may suggest that you invest in emerging market debt. And so today's piece is to educate you on the asset class. You already have exposure to a lot of different fixed income pieces, U.S. government bonds, corporate bonds, but today we're going to talk to you about bonds that are issued by emerging market countries. And Tom Shingler, who came to Callan with a deep fixed income background, is going to present the education piece to you.
Okay. Good morning, everybody. Everyone should have the presentation in front of them. I'll turn you to the second page, which gives an overview of some of the basics of the asset class. And in summary, what we'd say is that there are some very compelling features of emerging markets debt. It's come a long way as an asset class in the last 20 years, but there are also some key risks to be aware of. So that's what we're going to go through, and please stop me anytime with questions. So on the second page here, we've outlined some of the basics of the asset class. So historically, this was an asset class. It was really countries in emerging market countries issuing debt in foreign currencies like U.S. dollars or euros. But over time, the asset class has evolved a great deal, and it's much more liquid and sophisticated, though it's still really quite different than the developed markets. It's come a long way. Today, there are three main segments of emerging markets debt. The oldest segment, and was what was historically the biggest segment, but no longer is today, is what's called external sovereign debt. So that would be debt issued by a country like Argentina in US dollars or euros. So that's called external sovereign debt or hard currency debt. The second segment would be local sovereign debt or local currency debt. So that's a country, an emerging market country, issuing debt in their own currency, like Mexico issuing debt in pesos. And then finally, the third segment is emerging market corporate debt, so companies that are domiciled in emerging markets countries issuing debt in US dollars. So those are the three main segments of the market today. And on the third page, we provided a good summary of each of these asset classes and their main index. So these are products that have indices covered by JP Morgan. We've provided data for each of the indices for these markets from JP Morgan. So you can see the three categories: external sovereign debt, external corporate debt, and local sovereign debt, and the name of the main benchmark for each of those asset classes is right below there. And you can see for external sovereign debt, the currency is US dollar. For external corporate debt, the currency is US dollar again. And then local sovereign debt, that's local currency. These are indices that in general represent a very large number of countries. So you can see for external sovereign debt, that's representing 61 countries. External corporate debt, 42 countries. And the local sovereign market, where countries are issuing in their own currency, is quite a bit smaller at 16 countries. Now, for NYCERS specifically, it is important to keep in mind that these indices do include countries that would be on your restricted list, like China or Russia. So that's something to keep in mind. But they are very broad beyond that, as I said. So you got 61 countries for external, 42 for corporate, and 16 for local currency.
Can I? Yeah, I don't mean to interrupt you. It's your presentation, but just to give you an idea of the size of the universe, we can compare it to high yield. I'm just using round numbers. High yield, trillion plus,
right,
in size. As far as the market goes, this is a bigger market than the high yield market.
Yeah, we actually have the numbers here. So the middle of the page shows you the market value of each of these indices. This is just for what's in the index, but for external sovereign debt, that would be over $600 billion market. External corporate debt is over $700 billion, and local sovereign debt is over $900 billion. So these are very large markets. In terms of the credit quality, I think historically there's been a perception of emerging markets as very low quality, higher risk. That has changed and evolved over time. The fundamentals of emerging market countries have improved a great deal, and the overall credit quality of these securities has improved. So you can see we have listed the average credit quality for each index. They're all in the BBB range, so that's the bottom of your investment grade spectrum. Investment grade runs from AAA to BBB. So you're still above high yield, but you're at the lower end of investment grade. Compare that to the Barclays Aggregate, which is our main index in the US, and that's a AA rated index. So it's investment grade, but generally lower quality. And then in terms of yield, this is one of the very compelling features of emerging markets debt as an asset class, is the relatively high yields you can earn in the asset class. So if you look at external sovereign debt, it has a yield of 6%. On the index, external corporate debt 5.7 and local sovereign debt 6.9. So these do offer very compelling yields as to compared to, let's say, 2-3% in a lot of developed markets. And so what are some of the advantages and the disadvantages of each of these asset classes? In external sovereign debt, so remember here we're talking about US dollar issuance, so you're not taking on any currency risk, but you are getting a very significant pickup in your yield relative to developed markets or US dollar government debt. So there's a yield pickup there that's very attractive. Now in terms of what are some of the disadvantages, one of the main disadvantages is that you've got a high degree of exposure to treasury yields because it's going to be effectively a spread to treasuries that you're earning on emerging markets debt. And in that sense, you're getting less interest rate diversification because it is tied to treasury yields. In external corporate debt, this is a very large market today, but remains quite illiquid. So this would be the most illiquid portion of emerging markets debt, and in some ways the riskiest in terms of potential for default. Now, what does it offer on the upside? Again, you're not taking on currency risk because it is US dollar issuance, and you're getting a high current yield. And in terms of when Martin was talking about the high yield market, you're getting a higher yield than you would get in the US high yield market. So there is credit diversification and yield diversification that you're getting without taking on currency risk, but you do have to worry about liquidity and the potential for default. Finally, the local currency sovereign debt market. There, one of the main benefits is that you're getting currency diversification, so you're not, because the issuance isn't in US dollars, you're getting the benefit of issuance in these other currencies. You are also getting a high current yield. You're getting other interest rate exposure, so interest rate exposure to other countries versus the US interest rate environment. Now, in terms of what some of the disadvantages are, it's effectively a greatest strength, greatest weakness, where yes, you're getting this different currency exposure and you're getting this diversification, but there's also obviously the volatility that can come with currency exposure to emerging markets. So each of these three segments, the external sovereign debt, the external corporate debt, and the local sovereign debt market have some pros and cons, but all, we would say, have compelling features that make them worthy of consideration. Now, how do they look in terms of return versus risk? We've plotted here on page 4 for the last 10 years, ended December 31st, 2013, how these asset classes look compared to some other options like the U.S. fixed income market, U.S. high yield market, and U.S. equities and global ex-U.S. equities. So you can see on your y-axis you've got returns, and on your x-axis you've got standard deviation. And up near the top you've got EM sovereign debt, local currency in yellow, so you've got a pretty good risk-return trade-off there for the last 10 years. And then a little bit lower risk but lower return is EM sovereign debt, hard currency in the blue. And below that is EM corporate debt, hard currency in the green color. So if you compare that to some of the other riskier portions of the fixed income market, like U.S. high yield, for instance, this looks relatively attractive in terms of the risk-return trade-off. Page 5, here we're delving a little bit more into returns, comparing 3-year annualized rolling returns. If we look at what we could say is the more conservative end of the fixed income market, the U.S. fixed income market as represented by the Barclays Aggregate Index, compare that to EM sovereign debt, the U.S. dollar external sovereign debt index, you can see that consistently over time, generally, for the higher risk, you have earned higher returns in EM sovereign debt than you have in U.S. fixed income. So as we saw in the prior chart, it's higher risk, more volatility, but the returns are better. Now, to balance that, page 6, I think, is a good illustration of some of the risks. So while we say that this does have diversification properties going into emerging markets debt, while it certainly does, you can see that your correlation to equities is much higher over time. And this is going to be particularly pronounced in what are called risk-off times, when people get scared in the markets and they don't want to be in the riskier parts of the market. So these are showing rolling 3-year correlations of various fixed income asset classes to the S&P 500. And so you can see at the top of this chart, bank loans and high yield actually have the highest correlations of the ones we're showing. And then below that would be EM sovereign debt in local currency and EM sovereign debt in US dollars. Now much lower, and actually what has a negative correlation and much more of a diversification benefit relative to equities would be the Barclays Aggregate and US Treasuries. So you can see both of those two asset classes have a negative correlation to equities, and emerging market debt has a positive correlation that fluctuates over time. Now, turning to page 7, this is a good chart, I think, to show what the outlook is like today for emerging markets countries versus some of the developed market countries out there, and how healthy these countries are, relatively speaking, and what you're earning in terms of bond yields, even in spite of the fact that they're healthier from a financial standpoint. So on the y-axis, we see real GDP growth for annualized for 2012 to 2014, and you can see that you've got a lot of emerging markets countries here with pretty high rates of GDP growth. Today, they actually account for over 50% of global GDP, and that's expected to continue to rise. And then on the y-axis, we're showing gross debt to GDP ratio. So you can see that in terms of their fiscal situations, a lot of these emerging market countries are actually healthier in terms of their debt to GDP ratios than some of their developed market peers. And then those bubbles are showing you effectively how big the bond yield is on the 10-year government bonds. So you can see that in general, these emerging market countries that obviously have some other risks potentially are offering you a higher yield. Page 8, getting back to what I was just saying about how these countries are growing and their relatively sound financial situations in terms of monetary and fiscal policy. This chart gives a good historical overview of how these markets have evolved over time. So we're showing for the external sovereign debt index how much of the index is investment grade versus high yield or non-investment grade over the past 20 years. And you can see that about 20 years ago in 1994, less than 10% of this index was investment grade rated debt. And today, about 70% is investment grade rated debt. So these countries have come a long way in terms of how sound they are financially, and they've effectively become a much better credit for investors. So even though the credit profile has improved a lot, you're still earning an attractive yield over the developed markets, and you can see that on page 9. So we're showing yields over the last 10 plus years for the EM sovereign US dollar index, the EM sovereign local currency index, and developed markets sovereign index. And you can see that you're getting 400 to 500 basis points of additional yield over the developed markets sovereign index. Next 2 pages, these go into some more detail on bond spreads in emerging market. I'm not going to cover these in detail, but one main takeaway would be that in EM corporate bonds, you are earning a spread over comparable U.S. corporate bonds. Turning to page 12, this is to give the board an overview of what the products are out there. So if the board was interested in this as an asset class, what are some of the options for investing? And we've included the 4 main categories that are out there of ways to invest. One is investing with an emerging external sovereign product. One would be emerging local sovereign. One would be emerging corporate bonds. And then finally, there's a blended option that's becoming more popular where you have a mandate that a manager has to invest in all 3. So external sovereign, that's US dollar, local currency sovereign debt, and emerging markets corporate bonds. And the way that the markets have evolved is that today where you have the best depth of product and the longest track records to assess managers on would be in the external sovereign market in US dollars. That's where there's the most history and the most products and the lowest fees. But in terms of getting overall access to the asset class, another attractive option is giving a manager a blended mandate where they have the option to use their expertise and deploy assets in all 3 parts of the market. This isn't an asset class where you'd recommend going with an index. It's an asset class we'd recommend using active managers. And finally, page 13, this gives you a liquidity comparison. I think this is a good reality check on how liquid these markets are versus developed markets and U.S. Treasuries. So this is data that we source from BlackRock. They are one of the largest bond traders in the world. And this is the current data as of this month for bid-ask spreads. So what a dealer would buy something for, a bond dealer, versus what they would sell something for, the difference, the spread between those two. And you can see that the spread for emerging markets, external sovereign debt, and local sovereign debt are much higher than they are for developed market sovereigns and for U.S. Treasuries. Now, these markets have become more liquid over time, as I said, but they're still considerably less liquid than the developed markets and U.S. Treasuries specifically. It might be a little bit counterintuitive that external sovereign debt that's issued in U.S. dollars is less liquid than the local markets. And that's driven by a couple factors. One is especially today, is you got a lot of U.S. dollar investor nervousness about things like the Ukraine. So that's putting pressure on trading costs. And then in the local markets, those markets have grown a lot. The local sovereign market has become much more liquid. You've got a wealth effect in countries like Brazil, where the local citizens are investing in their own currency, and that is reducing trading costs. So finally, some of the summary pros and cons here. In terms of the pros, over the long term, there's a strong outlook for growth in the emerging markets. These bond markets are growing. They now are effectively 3 distinct segments. Very attractive from a yield standpoint. The breadth and depth of the markets is increasing. The liquidity is improving. So there's a lot of compelling features of emerging markets debt to give a plan like NYCERS some diversification. Now, what are some of the cons? When you've got a risk-off environment, some of these fundamentals that I talked about, like improving credit metrics of emerging market countries, those can be forgotten, and people will flight to quality assets like treasuries. The liquidity has improved, but as I just showed you, it's not where it is in the U.S. markets. We haven't talked really much about geopolitical risks, so clearly ability to pay has improved. These countries are sounder financially, but there can be geopolitical issues here that come into play and put these countries' debt at risk. And then from the perspective of your asset allocation, if you think about emerging market debt as part of your fixed income allocation, it's certainly going to be part of the riskier portion of your fixed income allocation. It's, as we saw in that chart with correlation to equities, this is an asset class that does have a higher correlation to equities. It's not going to give you the same flight to quality benefit as the treasury component that we have in the portfolio. It's going to give you other diversification benefits, but the risk return has to be assessed in the context of your overall asset allocation and what role you want fixed income to play versus your equity portion of your asset allocation, let's say. So that's an overview. Happy to take any questions that trustees have about the asset class.
Question? Are other funds investing in this product across
Yes.
the nation? Could you
Yes.
talk a little bit about that?
Definitely. Other large public funds, other types of investors, but certainly large public funds, ones that we work with, are including this as a small part of their fixed income allocation. One way to classify it would be as not necessarily opportunistic fixed income, but as more of your value-added fixed income versus your core anchor to windward fixed income.
And last question. If you were to plot core plus 5 on your charts, where
Sure.
would it be positioned?
Core plus 5 would be, so if we go back to that chart on page 4.
Yes.
Yeah, so U.S. fixed income, that's the aggregate, the Barclays aggregate, so it would be pretty close to there. think that's fair?
Yeah, it is. There are very slight differences. We have a higher yield and longer interest rate sensitivity. One thing I also want to point out to the board, we obviously at NYCERS have country restrictions. Given the size of again, you may decide not to do this, but when all is said and done, but in the event that if an asset allocation is decided upon and NYCERS wishes to put an allocation to emerging market debt, the country list, given the size, NYCERS $50 billion, if, let's say, pick a number, 3% allocation, that's $1.5 billion. The separate accounts that we're talking about would certainly be able to accommodate the country list restrictions. That would not be an issue.
And is it possible to get a copy of those countries?
The country...
On your permissible list?
Yes.
Yeah, Callan has. Okay.
We produce it once a year, and we'll be happy to send it to you.
Thank you. And I'd like a copy as well.
Sure.
Maybe we can circulate it to the whole board.
Absolutely.
I have a quick question. So, Martin, you threw out a number 3% or so as a starting allocation. Is an alternative to having a standalone emerging markets manager at such a small level? Perhaps, as an alternative, we could broaden out the mandate of an existing manager and let that manager invest in emerging markets?
We could. We would
they
have
that
to.
Capability?
We presently, in fact, emerging markets you do invest in because it's actually part of the index, a small part of the index, an investment grade in the Core Plus 5. If it's U.S. dollar denominated and it meets the minimum requirements for issue size and it's investment grade, there are, for instance, Mexico is the largest part of that piece. Mexican issues that are investment grade that meet the requirements. So we do have an investment. Yes, we could do that. Part of the issue with that is we have to evaluate changing that. So that presumably would be part of any asset allocation study as to a revised asset allocation study as to what we could do. Presently, though, we wouldn't be able to do it because of the basket limitations, and that's really what's stopping us there. The investments that we do presently in emerging markets, the Mexican issues as an example that I gave you, are legal investments. They don't hit the basket. What we're talking about here are not all basket issues, but most of them are. For instance, the law says you can't invest in securities that are not denominated in U.S. dollars. While we can have a policy and discuss at some later point, when we're at that point, on hedging or not hedging, the reality is that goes in the basket simply because it's not dollar denominated. That's why we prohibit that.
I think another consideration, too, is that there are a number of firms that specialize in this as an asset class, and that's virtually all they do as an investment manager. And some of the best managers are those boutique specialist firms.
Right. There are obviously the large firms,
yeah,
which I won't name now, that are the large fixed income firms. You name one of them, obviously they have emerging market debt and they can do very well. But there are many different flavors of this, as you'll see, if we end up moving forward and NYCERS is interested with this. There's many different flavors. You mentioned corporate, you mentioned sovereign, hard currency, local currency, hedged, non-hedged. There's many different flavors. In fact, in eVestment Alliance, I know you guys have your own databases, but even eVestment Alliance has 6 separate databases because of the different flavors of emerging market debt. There are differences.
Question?
Yeah, a couple of questions. First of all, the availability of the bonds, I know they used to be referred to, US-denominated bonds, used to be referred to as Yankee bonds. The opportunity set is large enough for both this fund and the funds across the country to purchase, and there's no issues with that?
No. Okay. There is
a couple of weeks ago, Callan came in and talked about the projected interest rate environment, inflation. How well is correlated are the markets, the international markets, the emerging markets, to the U.S.'s condition?
Well, that's where, when we get into the shades of gray of different portions of the emerging markets universe, so there's going to be higher correlation with sovereign debt that's issued in U.S. dollars, where you're earning a yield over the U.S. Treasury rates. So there you're going to have higher correlation than a country issuing in its own currency that has its own interest rate environment and its own currency that is valued at whatever it's valued at relative to other countries. So it does depend to some degree on what part of the emerging markets debt you're investing in.
In the decision to make country-specific investments, leaving that up to the manager within ranges, or how are the two put together to make sure that we're not overly concentrated in an area that might have an inflationary risk, I guess?
Well, I think, and this would have to be discussed in more detail in terms of how it fits with the overall asset allocation, but one way of doing it is, as I said, the blended option, but that can introduce more risk in the sense that you potentially are taking on currency risk if it's not hedged. So if you're doing, let's say, just US dollar denominated debt, you're going to have more interest rate sensitivity to the US markets, but you're not going to have any currency risk. So each component of it does have a risk-return trade-off to it, and it's hard to just look at it on its own. We'd have to look at it in terms of how it's going to fit into the rest of the fixed income allocation and even to the equity.
Right, and I also want to point out the more likely restrictions that we have in guidelines, and we're getting ahead of ourselves here, but the more likely, to answer your question, the more likely restrictions would be regional. So, in other words, you have South America, you have Asia, you have developing Europe. We wouldn't want a portfolio that is all invested in Estonia, for instance. So, it wouldn't necessarily be country risk, although that would be there as well, country limitation, but it would be regional limitations. But also we would look at the managers, because there are some managers that do have expertise in, let's say, South America. So when we're at that point, we'll be bringing managers that make sense in a portfolio of managers. We're not hiring one manager, that we have managers that do general things and managers mix it and supplement it, have satellite portfolios where managers have specific areas of expertise.
Well, just one final question. You did talk a little bit about, I guess, the FX hedging risk for local currency. Is that something that's being entertained? Does that fold into the basket clause issues? How does that interplay? A little bit of interplay?
It does. It does. Our present interpretation is it does impact the basket. But I will tell you, you can look at let's look at our non-U.S. equity portfolio. Our non-U.S. equity portfolio, we allow our managers to hedge in certain circumstances, but we don't have a specific hedging policy. And part of the reason for that is the currencies themselves over the long run offer a great diversification, and we don't have enough of that. So that is part of that. While yes, there can be risk, and you can limit that in guidelines, it's actually a risk you may want to add to the portfolio for the diversification benefits.
And the decision on FX hedging would be a future discussion based on costs and the other things associated with that.
Based on costs, the manager's records, we may be bringing you, we're talking a year from now, but if we bring you a manager that does not hedge or hedges opportunistically, and that's their that's an important part of their record, if we were to tell them, well, our policy is this, we may not want to look at that manager because that's what they do.
Thank you.
But that's when we would bring you an overall portfolio manager.
We did an analysis on, Callan did an analysis on hedging, FX hedging, on the overall portfolio about a year ago, I think, and I went through this in great detail, and the answer really was that it's not worth doing it for the portfolio.
Right. Well, I think at that time you had about 17% exposure to non-U.S. currency, and we felt that at that level it was beneficial to have that diversification in currency. Once you got maybe to the 25% or more, then it might be worth hedging some of that risk. But at the 17% level, it was additive as a part of diversification.
Yeah, so that would be part of the discussion of when we come to that point of selecting managers and an IPS and a policy and all that.
Do the three segments have different time horizons and terms? What's unusual time horizons?
Well, they're all liquid daily trade in terms of duration, the external sovereign debt has longer duration, so a little bit more interest rate risk in the sense that it has longer duration. But these are all liquid, daily valued, traded securities. So the ability to liquidate a whole portfolio is longer than, let's say, the S&P 500. But these are all mark to market on a daily basis.
Corporate issuers are typically 5 to 10 year maturities. Sovereign issuers they have a yield curve, so there are shorter maturities and there are longer maturities, just like the U.S. Treasury can go out 30 or even more years.
Are you seeking approval today for Callan's participation
Correct.
in the search?
Correct.
And then the plan is to come back to the board with a 2.0 educational session to talk about many of the things and the questions that were raised today?
Right. So Callan's participation in the search is really what we're looking for. And then ultimately, in combination with the basket and potentially tweaking and changing the asset allocation, coming up with an IPS and manager recommendations from that search.
Okay.
Or, if the board decides to opt out, not to do it.
So does that require a formal vote of the board?
That's a good question. I don't know.
Is this currently under the scope of Callan's contract?
Yes.
It is.
It is.
So there's no separate charge for
There's
this.
no, yeah.
No, so it wouldn't, since there's no additional cost and it's part of Callan's services, it doesn't seem that it would require a board.
Right. We would show you the scope as we would any other RFP. And just as far as timing goes, we're going to all the boards other than teachers to do this. So we're doing tips. You'll be seeing that very, very soon. This will follow shortly after tips, after we go through all the boards.
Okay. And Diana, did you have a question?
I just wanted to find out, as far as the search is concerned, is that going to include what would be MWBE?
We are going to make, short answer is yes. We're not excluding them, but there are a number of managers in the universe, and because of the new process, where we can make the minimum requirements lower, that would allow more MWBEs to participate, to be eligible than ordinarily in the past, where the RFPs had to be filled out and sent to us, and given how much money we have to allocate, again, I'm using a 3% number, which may or may not be the right number, but let's use 3%. It's $1.5 billion just for NYCERS. Well, $1.5 billion, if we're going to if a manager has an MWB has $500 million, and we don't want to do more than say 10%, that's $50 million of that $1.5 billion. So it takes a lot of managers to get to that point. So that's why we have our developing manager program. But in this case, we are going to make and our plan is to make the minimum requirements low enough that to be more inclusive.
And what is the current percentage of what would be previous searches of actual MWBEs contracted?
It depends on the outcome of the search.
You mean just within fixed income, or?
I can give you some examples in fixed income. So 10 years ago, we had probably 50 to 20% of our assets in public market fixed income in MWBEs. That was not necessarily because we had a separate program, but those were the best managers. We have a much lower number now. Why? It's actually good news. Two of the larger managers, one of the managers presently manages for you, TAP in Canada, they manage $1.5 billion across the system, across the systems approximately. They sold to a bank, so it was a successful business, and they sold and monetized their investment. But that we don't consider them an MWBE anymore, even though the MWBEs are still managing based on the rules and the law. 51% of the firm is not owned by MWBEs. So our number has gone down. But nevertheless, historically, fixed income has had significant numbers in MWBEs outside of our developing management program.
So as in reference to the search, will we know what companies will be identified as MWBEs or in the presentation?
Yes, of course.
Fantastic.
Yes.
Thank you.
Just clarification, that's not per se MWBs, it's emerging managers, using the criteria
Correct,
of
correct.
the board.
Smaller managers,
Both.
but we can also identify MWBs.
Correct.
And I think we did that in a previous presentation, so, yes.
Just one further, as I was thinking, is we just talked about the permissible investment country list. I forget when that is done on a periodic basis, but if a specific section of that report could be done specifically to the emerging manager debt and specific risks to the country on the debt, as opposed to maybe greater country risk, that might help the decision-making process.
Do you know the timing of when the next list is being prepared?
Well, September. Every May we come out and we talk about sort of the preliminary screening criteria that we're going to use. And then in September, we present the findings of our research with the help of our subcontractor, Veritas. And so it's the September meeting that we will have the updated screens presented to you.
Are you going to look at specific criteria as it relates to emerging, to the debt, specifically?
I'll talk to Veritas, who does this actual screening, and make sure that they include the debt side.
Okay, thank you.
Yeah, I mean, the current structure of the screening has 7 different factors.
And one of the key factors.
One of them is, political stability, capital market openness, labor laws, et cetera, et cetera. So it's not specific to debt within that country, but it encompasses all of it.
And a key feature
Factors.
is the rule of law, because if you have a Chapter 11 or the equivalent in a country, what's the probability that we get a recovery, and that is part of the search, part of the evaluation, the rule of law.
Any other questions from the trustees? Thank you, that was very helpful.
And thank you.
Thanks.
And Seema, any other items that you'd like to discuss in public session tomorrow?
Nope, that concludes our agenda for the public session.
Okay, so then I would need a motion to enter an executive session to discuss matters leading to the appointment and/or removal of a particular corporation.
I make a motion to go into executive session.
Okay, do you have a second?
Second.
Okay, all in favor? Aye. Any opposed? So shall